All right, welcome. Tonight, we're going to be talking about fixed assets, accounting for property, plant, and equipment, or fixed assets or capital assets. They're all used interchangeably, these terms. They're basically long-lived assets that companies can use to run their business, generate profit, hopefully revenue. So we're talking about how to account for that. So basically, there's two types of expenditures. There's either a capital expenditure or a revenue expenditure. What do I mean by that? That means every expenditure is going to be either one of or two places. It's going to either be debited to an asset account or debited to an expense account. A capital expenditure is capitalized or debited to an asset account, and a revenue expenditure is debited to an expense account. A capital expenditure has long-lived, it's going to last longer than a year or an accounting cycle. Whereas a revenue expenditure it has no useful life beyond a year. It's just going to be an expense for the current period against revenue. Okay, so we'll be focusing on how to account for capital expenditures, and what gets capitalized to the asset account are all those expenditures that are both normal or reasonable and necessary to get the asset ready for its intended use. What do I mean by that? Well, let me share my screen with you for a bit here, and I'll show you what I'm talking about. So, for instance, if you're buying a piece of land, what goes into the cost of the land? What gets debited to the land account? Well, the purchase price of the land itself, of course. So if you bought a piece of land for $1 million, you debit land account for $1 million and credit cash or notes payable or whatever, how you financed it. And if you had to pay a commission to the real estate agent, that would also be capitalized to the land account, and any legal fees associated with getting acquiring the land. Also, any costs of draining, clearing, demolition. If you had an old building on there you want to get rid of, that demolition cost would get capitalized to the cost of the land. If it costs $25,000 to remove a building, a small building, then you would debit land for $25,000. If you have assessments and for streets, sewage system, etc., all these costs are normal and necessary, or reasonable and necessary, to get the asset ready for its intended use. If you have a building, if you have the purchase price of the building or construction price of the building, if it's new construction, commission to the real estate agent, legal fees, repair, remodeling costs, if it's a used building, if you can't use it until it's remodeled, then that would get capitalized as well. Payments to tenants for premature termination of a lease, that would also get capitalized. All these costs are normal and necessary to get the building ready for its intended use. Okay. If you had to buy a piece of equipment, of course, you'd have the piece of equipment itself. Then you have a transportation cost to get the equipment from the manufacturer to your building. That would get capitalized or debited to the asset account called equipment. Any insurance, if you're insured while it's in transit, which is always a wise thing, then that would get capitalized to the asset account as well. Any assembly, installation, if you have to run power out to the area where you're going to plug it in, then you're going to capitalize that electrical costs. Any particular inspection or training would also get capitalized. Initial training would get capitalized, and then anything else, special footings, you have to pour a special footing for the machine so it won't rattle or shake or what have you, or need some support underneath it. Then yes, that would all get capitalized to the asset account. Capitalization stops when the asset is ready for use and you start using it. Once you start using the asset, the capitalization period stops. You've finished debiting the asset. Now, if you have, let's take the equipment for instance, you have any normal ordinary repairs like oil and grease and what have you, changing out a piston or a rod or what have you, that would just get expensed as you go. Any training after the asset's up and running would get expensed. Okay? So once the asset's up and running, you would expense normal and ordinary repairs and maintenance and what have you. If you have a repair that is going to extend the usefulness of the asset beyond a year and it's going to extend the life of the asset, then you could look to capitalize that. Okay, and I'll give you an example of, or if you make an addition to it. So let's say you had a building, you had a 100,000 square foot building, you want to add another 50,000 square feet. Well, that 50,000 square feet, even though you're already in the building and using it, that would be capitalized as an addition. I'll give you an example of a truck. If you had you bought a delivery truck for $50,000 and you start using it and you're making deliveries and all that good stuff. You blow out a tire. That tire that you have repaired would be expensed. Okay, if you have bring it to the shop to get an oil change, that would be expensed. If for some reason you're delivering these for your customers and they require you to now carry refrigerated product on your truck, and you don't have a refrigeration unit, a reefer, as they call it, then you'd have to go buy one. Let's say it costs $10,000 to put a refrigeration unit in a box, so you can pipe in the cold air into the box so things don't perish. Then you could capitalize that because you didn't have a refrigeration unit on your truck to begin with. If you repaired your refrigeration unit, that's a different story. Okay, but this is a new addition to the truck, you would capitalize that. If after a couple of years you're running the truck, the engine falls out for whatever reason, it blows up, and you had to buy a brand new engine. And that brand new engine is going to extend the life of this truck for beyond the normal existing life of the truck. Then you would capitalize, take the old engine off the books and put the new engine on the books. You would capitalize that engine, and then you'd take the old engine off the books. Okay, so those are some examples of how you account for the capitalization of assets. Again, capitalization is just a fancy word. If you had a party this weekend, someone's talking about capitalization, all they're talking about is debiting an asset account. That's all they're talking about. So you debit an asset account instead of an expense account. All right. So let's go. We're going to go into some examples of how to account for these fixed assets, these capital assets, PP&E. Again, all these terms are used interchangeably. So we're going to look at that, and we pull up a spreadsheet. We're going to go through that, some examples together. Let me share my screen with you, and here we go. So we have an example here of calculating depreciation by 3 methods. So once you have an asset on the books, you need some way to write that asset off over its useful life. Okay, so you have this. Let's say you spent, well, in this case, $950,000 for a printing press. Now that printing press has an expected life of 10 years or 1 million units, and expected to have a salvage value or residual value of $50,000 after 10 years of use. Okay, you can see that here in the description of this problem we're going to be going over together. So you need 3 things to calculate depreciation. One, you need the cost, what you capitalized. In this case, we debited the equipment account for $950,000, so we need that. We also need to know the estimated useful life. In this case, it's 10 years or 1 million units. We're going to see how we use both of those. And then you need a salvage value if you use salvage values. And that's going to be, in this case, $50,000. So after 10 years of use, they expect the salvage value to be $50,000. That's what they can get for it at the end of 10 years of using it. So one of these numbers is hard and fast. It's what you paid for it, what you capitalized, $950,000. The other 2 numbers are estimates, the estimated useful life and the estimated residual value at the end of when you're done using it. So the estimated useful life is not some just reach out and grab some random life. It's typically, companies have a policy, typically new assets might be 10 years or 15 years. Used assets might be 5 to 7 years. You might use the IRS code. You can use those as well. But the point is you want to be consistent. If you use 10 years for new assets, then you're going to use 10 years all the time for the most part. You don't want to, you want to be consistent. Consistency is so important in accounting. So here we're going to calculate depreciation using 3 methods. And what is depreciation? It's just a systematic write-off of the asset over its useful life. That's all it is. That's what depreciation is. You want to expense or match the expense of that asset with the revenue. So as the asset's producing, you want to write off that asset over its useful life as it's producing. okay, or sometimes not producing, unfortunately. Okay, so let's look at an example here. Fielder Company purchased a printing press on January 1st for $950,000. The machine is expected to have an estimated useful life of 10 years or 1 million units. The machine is expected to have a residual value of $50,000 after 10 years of use. We're going to calculate the depreciation using the straight line method. What is the straight line method? It means we're going to calculate it and use that same depreciation over the life of the asset. It's based upon time. So we're going to take our cost, $950,000, minus the salvage value, the part we don't want to depreciate, the $50,000. So we're going to take 950,000 minus 50,000. We're going to take that $900,000 and divide it by the 10 years to get a depreciation per year on a straight line basis. So let's calculate that. I built some tables over here. So let's pop down and get the year. We're going to use this beginning book value. We're going to calculate the depreciation expense for the year and then the ending book value. Okay, so let's take a look at that ending book value. Okay, so year one, which is 2020. Okay, what's the book value at the beginning of the year? The book value day one is going to be what's you capitalize. In this case, $950,000 is the book value at day one. What's the depreciation expense going to be? Well, put a formula in here. It's going to be the cost, $950,000, minus the salvage value or residual value, net $50,000, divided by the estimated useful life, in this case, 10 years. So 950 minus 50 is 900,000, divided by 10 is $90,000 for the year. What's the ending book value? It's going to be the beginning book value minus the depreciation, and we have $860,000. Now, this depreciation accumulates over time. Okay? So we have an account called accumulated depreciation. So we keep the asset on the books at cost, $950,000, and when we record the depreciation expense, we're debiting depreciation expense and we're crediting the contra asset account called accumulated depreciation. Okay, so this way we can look at the books and see what our cost is, and we can see how much depreciation we've accumulated. So it gives the reader of the financial statements a pretty good idea of how old the asset might be. Because if they see a cost on the books of $950,000 and depreciation of $900,000, they're going to say, "Oh, this asset's pretty much fully depreciated." Okay, well, it's getting old. It's older. If you see $950,000 and only $50,000 of accumulated depreciation, you're going to see on the balance sheet that this asset is fairly new. Okay, so let's look at the next year. So 2021 is the next year, and what's the beginning book value was last year's ending book value, $860. The depreciation expense on a straight line basis is going to be the same. Again, it's the same formula. It's going to be the 950,000 minus the 50,000 divided by 10. It's always going to be the same for straight line. Okay, and the ending book value is going to be the difference between the beginning book value minus the depreciation expense. Okay, and we can just copy this down because it's a straight line. I'm just going to copy all the years down. And you can copy these formulas all the way down because it's going to be the same expense every year. And you're going to see, whoops, bird shells, of course. Let's just do this. Boom. And then this, boom, and then this. All right. So we'll see that at the end of the depreciable life of this asset, 10 years later, we have a book value of $50,000, which it should be because we didn't depreciate that piece. We backed it out of our equation here, right? We had the cost minus the salvage value divided by 10 years. So we're not depreciating the salvage value. So when you get done depreciating the asset, you'll have a salvage value left on your books, your book value. Your book value will be $50,000. And you always measure the book value by the cost minus the accumulated depreciation. That's how you measure book value at any point during the year or during the life of the asset. Total depreciation for this asset is $900,000. Okay, $90,000 for 10 years, $900,000 of depreciation. So the beginning book value minus accumulated depreciation equals an ending book value at the life of the asset of $50,000. Okay. All right. So that's straight line. It's just calculate once and then hence it's a straight line. Okay. That's where you get straight line depreciation. It's the same expense every year. Okay. So let's take a look at another method. We're going to talk about three methods tonight: the straight line, the units of production, which is an activity method, and an accelerator method called double declining balance. So let's take a look at the next one, which is a units of activity or units of production method. It's an activity method. The activity method does the best job of matching the expense with the revenue, because you are taking depreciation based upon the actual units, in this case, produced by the machine. So when they're producing units, it should be generating revenue. So it's going to more closely match your expense with the revenue when you use the units of production method. So let's take a look. We have another table down here. So let's get there. We'll put the year. Okay, I'm going to caption here the beginning book value. And we're going to put here the usage in units. And we're going to put the rate, what the depreciation rate is, and to calculate our depreciation expense and get our ending book value at the end of the year. Okay. Again, we have the same years, 2020. And I'm just going to put a formula here to copy it down. So 2021 all the way down to 2029. Okay. So what's our beginning book value? Again, it's $950,000. Day one, it's what we capitalized. $950,000 worth of cost on our books. What is the usage in units? Of course, we don't know this ahead of time, but we know what projected units are. The projected units are 1 million units. So what if during over the 10 years, we use this machine based upon these number of units? So in the year 2020, we used 102,000 units. Okay, what is the depreciation rate? Well, instead of getting a rate per year, like straight line, units of production gets a rate per unit or hour, if we're dividing by hour, whatever the denominator is. All right. So let's calculate that. So same formula, we take the cost of 950,000 minus the salvage value, the part we don't want to depreciate, divided by not years this time, but units, 1 million units. Okay. So the estimated life of this printing press is 1 million units. So we're going to take the $900,000 of depreciable asset divided by the million units, or 90 cents a unit. So for every unit we manufacture or produce, we are going to take 90 cents of depreciation. So depreciation expense is going to be simply the number of units times the cost per unit of the depreciation based upon the million units estimated. So we're going to have depreciation expense of $91,800 in the first year. The ending book value is going to be the beginning book value minus the depreciation expense. Again, when you make a depreciation expense entry, you debit depreciation expense and you credit the accumulated depreciation account. You don't credit the equipment account. Okay, the equipment account stays on the books at cost, and you capture the depreciation in this contra asset account as an opposite side balance called accumulated depreciation. Okay, so then year two, what do we have? The beginning book value was last year's ending book value. The usage in units, in this case, are going to be 115,000 units. That's what we used. The depreciation rate is still 90 cents. It's going to be 90 cents the whole way down. Okay, just copy it right down. Oops, that's not going to work. Let's copy that and paste it in. Okay. The depreciation expense is going to be the same formula. Again, number of units used times the depreciation rate of 90 cents a unit. So 103,500. Ending book value, again, is going to be our beginning book value minus the depreciation. Now our ending book value at the end of year two is $754,700. We've accumulated $195,300 of accumulated depreciation after 2 years. Okay, so the cost of $950 minus the accumulated depreciation of $195,300 equals an ending book value of $754,700. And we know that the beginning book value is last year's ending book value. And just copy this formula down. Okay. Oops, all the way down. I can copy this formula all the way down. and copy this formula all the way down. Okay, the only thing that's changed is now we have to calculate or enter the number of units for every year. So 2022, we use 123,000 units. So it calculates the depreciation of 110,700. Then year 4, 119,000 units. Year 5, 115,000 units. 2025, year 6, 105,000 units. 2026, we have 95,000 units used. 2027, 88,000 units. 2028, 75,000 units. You can see the number of units are tailing off as the machine gets older, okay, which is typical. Okay, so all in, we had 1 million units over the life of this asset. It doesn't mean that that this machine is now no good. And I want to bring that point up. Just because the asset's fully used or depreciated based upon the estimate doesn't mean we stop using it. We can get another 10 years out of this asset. Just means we have no more depreciation expense on it. We've done depreciating it. We got more life out of it than we estimated. That's a good thing, unless the repairs to keep it going exceed the benefit. So that's something else to consider. And depreciation expense over the life of this asset is $900,000. Again, we have 1 million units at the 90 cents per unit rate is 900,000. And look at that. Our ending book value is $50,000. That's our salvage value. Why? Because we didn't calculate, we stripped that out of our calculation. So that should be your ending answer, $50,000 ending book value at the end of when you're done depreciating this asset. Okay. So now we come to an accelerated method called double declining balance. Double declining balance method takes a lot of depreciation in the early years and it tails off in the later years. It's like a ski slope. Could be a blue, a green, or blue, or black diamond. Depends on how steep it is, but it's like a ski slope. So let's look at that, calculating the double declining balance method. We're going to build a little table here with the year. We have the beginning book value. We have the double declining balance rate, the depreciation expense, and the ending book value. Okay. So again, the same years, 2020, 2020. I'm going to copy that down, all the way down to 2029. Our beginning book value, once again, $950,000. Okay. What is the double declining balance rate? First of all, let me explain what double declining balance is. Double declining balance is an accelerated method of depreciation. It takes twice the straight line rate. Okay, twice the straight line rate. So what in the world is the straight line rate? Well, we know this is a 10-year asset, right? Well, 10 goes into 100, how many times? Whoops. 10 goes into 100 10 times. That means there's 10 tens in 100. So the straight line rate is 10%. Every year we're taking 10%. Okay. If you had a 20-year asset, take 100 divided by 20, it'd be 5% every year. 25s equals 100. 5 plus 5 plus 5. Every year you're taking 5%. If you had a 20-year asset, you take 100% divided by 20. Every year you're taking 5%. I'm sorry, a 5-year asset divided by 5. Every year you're taking 20%. This is 5 20s and 100. 20%, another 20, another 20, that's 60, another 20 is 80, another 20 is 100% of the depreciation. Okay, so that's how you calculate the straight line rate. Again, it's 100% divided by the number of years. In this case, 10 years. We're taking 10% every year. That's how you calculate it. So the double declining balance rate would be twice that, or 20%. Okay, it's the 10 times 2. Okay, so the key is calculating the straight line rate first. You basically divide the number of years useful life into 100, and then you multiply it by 2. So the depreciation expense in the first year is going to be the $950,000 times 20%. We don't strip out the salvage value in this calculation because we're basing our depreciation on, it's called double declining balance. the balance is always going to be the book value. You're taking the depreciation on the book value. So you're taking 20% of the depreciation in the first year, $190,000. That is a lot more than 90, more than double, okay? And it's more than the units of production. So the ending book value is going to be the beginning book value, what you capitalize, minus the depreciation, 190,000. Now you have $760,000 as your ending book value. So why would companies want to have such a large expense on their books? They want to show less profits? Well, why? Well, the main reason for using the accelerated depreciation is for tax purposes. If you have a higher depreciation expense, you have a higher deduction, and the higher Internal Revenue Code, the IRS, allows you to use accelerated depreciation method that helps businesses grow their business. They incentivize companies to use accelerated, even bonus depreciation, which is beyond the scope of this course, but to incentivize companies to invest, because they know if companies invest, usually what comes along with that is employment. They're going to create new jobs and what. So the IRS incentivizes companies, especially with this bonus depreciation. Companies, if they're investing a lot of capital equipment, then they can defer their taxes out into a future year. They may pay no taxes this year, but eventually they have to pay the taxes. They get to defer those taxes out. Again, beyond the scope of this course, but the accelerated is used for tax purposes for the most part, or for those companies that say, okay, we have the lion's share of our production in the early parts of the life of the asset. Let's take more of the depreciation in the early parts of in the early years of the asset, and less in the later years as the equipment starts to get worn down and the repair costs go up. So as the depreciation goes down, the repair costs are going up. Okay. All right. So let's look at year two. Again, we have the ending book value with beginning book value for year two. Still at the 20% rate. Again, it's used for the whole life. So if we just copy that down, copy and paste it in all the way down, it's always 20%. Boom. Till you get to the last year, I'll show you. All right. And then the depreciation is always going to be a beginning book value times the 20%, in this case, the double declining balance rate. And the ending book value is going to be the beginning book value minus the depreciation expense. We can copy this down, and we can copy this depreciation expense down, and we can copy the ending book value down. The same formulas all the way down. Now, here's a problem. When we do this, we've only depreciated $847,995 because 20% of the beginning book value of 2029 only gives you 25,501. We're short by $52,005 of depreciation, because the answer should be 50,000 here. So the last year, you're basically plugging the depreciation for the last year. In this case, we're taking $77,506 of depreciation to arrive at a book value of $50,000. Okay, so again, it's the same answer, $50,000 at the ending book value, regardless of which depreciation method you were using. Okay, just the last year, we would be higher or lower than what's calculated. So this is kind of a fudge number, if you will. Okay, it's perfectly legal. Okay, you're not going to go to jail for fudging this last number. It just happens. That's the way it's calculated. Okay. So which of these three methods results in the lowest net income for 2022? Was the one that has the highest depreciation expense. So we see that 2022, the depreciation expense is $121,600 for double declining. It's only $110,700 for units of production, and it's only $90,000 for straight line. So the answer is the double declining balance method. Which of the three methods results in the lowest net income for 2026? Again, which one has the highest expense? 2026, double declining balance is only 49,807. Units of production is 85,500, and the straight line is 90. In this case, the straight line has the highest expense, which result in the lowest net income on the books. Okay? So that's how you calculate the three methods of depreciation. Straight line, units of activity or production, and double declining balance. I put a graph over here. You can see graphically what it looks like. Let's go over here and take a look at it. See, under these three methods, you see that we have the same depreciation over the life of the asset, $900,000. If you compare the three methods, the straight line is exactly what it is. In the orange here, the straight line is exactly a straight line. It's $90,000 every year. The units of production is choppy, right? We get 91.8, 103.5, 110. It follows the activity or the production of the press in this case. So you see it goes up, the gray line, and comes down, and it's just a little choppy. It's not straight, it's not like linear. It follows the actual production of the equipment. And then you have the double declining balance method, which looks like the ski slope with actually inverse check mark here, because we have the last year is plugged for 77,506 to arrive at the 900,000 of depreciation. But you see here a lot of depreciation in early years, and you see where it intersects the straight line somewhere around just year 5, in the middle of year 4 and year 5, and then it spikes up a little bit the last year just to make up for any calculations from the model or the table, if you will. Okay, so that's how you calculate depreciation across three methods. All right, and as I mentioned before, when you're calculating depreciation, we have one number that's hard and fast, the cost of the asset. But we have two numbers that are estimates, estimated useful life and the estimated salvage value. What happens if you get this part wrong? Let's say you bought a new asset that you never seen before, and you estimated the life to be a certain number of years, and you realize a few years in that, oh boy, I got this wrong. This is either going to last a whole lot longer or a whole lot less in life. So now we're going to talk about revising depreciation. So let's take a look at that. Okay, so Monster Inc. Purchased a machine for $500,000 and depreciated on a straight line basis over a 15-year period. The machine has an estimated residual value of $50,000. After using the asset for 5 years, the management realized that the machine will wear out before 15 years. Starting in year 6, the company began depreciating the machine over a revised total life of 12 years. Okay, so let's take a look. I'm going to draw a couple of T accounts up here, just for fun. Okay, let me draw some here. T accounts are fun. Accountants love T accounts, let's face it. Okay, so let's put something in here. Let's call this machinery. Okay, I'm gonna draw a little. Oops. Line down the middle here. Okay. And then we have accumulated depreciation. I was copy this over. Boom. I call this accumulated depreciation on machinery. All right. So here we have this asset. We started depreciating this asset. When we first purchased the asset, we paid or we capitalized $500,000 for this asset. Okay. So we're going to calculate the depreciation expense for year 1. So day 1, when we start depreciating this asset, what is the depreciation expense? Well, it's going to be the cost of $500,000 minus the salvage value, which in this case is $50,000, okay, divided by the estimated useful life, which was initially 15 years. So day 1, we were depreciating $30,000 a year. Okay. So after 5 years of depreciating this asset, debiting depreciation expense, crediting accumulated depreciation, we have in the accumulated depreciation contra asset account, we have $30,000 times 5 years, or $150,000 as a credit balance in the accumulated depreciation account. Okay, so the book value is going to be the cost minus the accumulated depreciation. So it's going to be the $500,000 minus the $150,000, or $350,000 is the book value at the end of year 5. Why is that important? Because we're going to take this book value and we're going to revise the depreciation based upon the remaining book value. So we're going to take to calculate the revised depreciation in year 6, because what happened after 5 years of depreciating this asset, the company realized we're only going to get another 7 years out of this asset, only 12 years in total. So we're going to take the remaining book value, in this case, $350,000, minus the part they don't want to depreciate, which is the salvage value of $50,000 still, okay, divided by the remaining useful life. In this case, it's going to be 7 years. So we're going to have depreciation of $42,857 a year for the next 7 years, beginning in year 6. The book value after year 12 is going to be what? It better be $50,000, right? Let's just see what happens here. So let's put the $42,857 times 7 is $299.99, which is rounded. So it's going to be there's going to be a dollar difference here. So we'll just plug the dollar in. It's 300,000, right? It's 42,857. This is rounding. It's off by a dollar when you multiply that out. So the 300,000 plus the 150 over the life, when you get done depreciating this asset over 12 years, you have a book value of 50,000, right? The cost minus the accumulated depreciation, $50,000. Okay, so that's how you revise depreciation. Okay? You revise it based upon, again, whatever management believes it, either more or less useful life, and then you depreciate the remaining book value over the remaining useful life of the asset. Okay? And then let's talk about what happens when you're done with an asset. You want to dispose of an asset. Okay, disposing of an asset, you have a few choices. You can either get rid of it, if nobody wants to buy it, you just go and scrap it, send it to the junkyard, or you can sell it. You can sell it for a gain or a loss, depends on what the market will bear, or you can trade it in for another asset. Okay, so let's look at what we do here. Example: Dewey Corporation purchased a machine for $720,000 on January 1st, 2015. The machine had an estimated useful life of 10 years and an estimated salvage value of $20,000. The machine was depreciated using the straight line method. On May 12th, 2021, the company no longer needed the machine and sold it for $205,000. Dewey takes a half-year depreciation for the year an asset is disposed. Okay, and that's typical. Companies typically use a half-year depreciation in the year of acquisition and a half-year depreciation in the year of disposal, when an asset is purchased mid-year. Here, this asset was purchased in January 1st, beginning of the year, take a full year depreciation. But typically companies, if they have assets to buying throughout the year and placing in service throughout the year, they'll take a half-year depreciation in the year of purchase or placing in service, and take a half-year depreciation in the year of disposition if the asset is bought or sold in the middle of the year. Okay, in this case, it's sold in the middle of 2021. Okay, so what is the book value of the machine at the end of 2020? That's a great question, right? So first we need to do is calculate the book value, the depreciation expense every year. Let's do that. So the depreciation expense is going to be the cost, $720,000, minus the salvage value of $20,000, divided by 10 years. So every year they're going to take depreciation of, $70,000 every year. Okay, they're going to take depreciation of $70,000 every year. How many years did they depreciate this asset for? So we're going to multiply it by the number of years. So 15 2015, 16, 17, 18, 19, and 20. 6 years of depreciation. So there's $420,000 of depreciation. So what is the book value? It's going to be the cost of 720 minus the 420 that's depreciated or accumulated over the 6 years. 70,000 a year times 6 years is 420. So the book value is going to be the $720,000 minus the depreciation. So we have $300,000 of book value at the end of 6 years, end of year 2020. Okay, so when we were done depreciating this asset at the end of 2020, it had a book value of 300,000. Again, cost of 720 minus accumulated depreciation of 420 is $300,000 of book value. What is the depreciation for 2021? Well, the asset was disposed of mid-year 2021. Okay, so what's the entry going to be? It's not for a full year. It's going to be a half-year depreciation. So the entry for Part B is going to be, we're going to debit depreciation expense. Let's find it, depreciation expense. And it's going to be for half a year. Well, we know a full year is $70,000, right? Divided by 2 is going to be $35,000 for half of a year. And we're going to credit the contra account called accumulated depreciation of, so 35,000. Okay. So far, so good. So now we need to calculate the book value at the time of the sale. Well, the book value at the end of 2021 was 300,000, and we just depreciated 35 more. Then the book value is going to be 35 less than it was at the end of 2020. It's going to be $265,000 at the time of disposal. So that's important to know. At the time of disposal, you're always going to be looking at what is the book value after you bring the depreciation up to date. That's important. First thing you do is bring the depreciation up to date, which we did with a half-year depreciation for 2021. Okay, when we subtracted that depreciation from the book value of 2020 to get the book value at the time of the sale. Okay, and we always compare the book value at the time of the sale to the proceeds that we got from the sale. Okay, so now we're going to record the sale on May 12th in the journal provided, assuming we got $205,000. So the first thing we want to do is take the asset off the books. Now, how do we do that? Well, the accumulated depreciation has a credit balance, so we're going to debit accumulated depreciation for the total amount of depreciation, which would be, again, it's the $70,000 a year times the 6.5 years, right? Or $455,000 is on the books, sitting in the T account for this asset. Again, $428,000 we saw for the first 6 years, plus the $35,000 that we just depreciated in year 2021. We have $455,000 that we have to take off the books of accumulated depreciation. Then we take the machinery off the books. And the machinery is on the books for $720,000. So here we are taking the book value of $265,000 off the books. Okay, the cost minus accumulated depreciation. Take it right off the books. It's no longer, we don't own it anymore. It's gone. The next thing we want to do is apply the cash. How much cash did we get? Cash came in, $205,000. It goes on the coming in side, which is a debit. So on the left side, so we debit cash for $205,000. And now we compare the 205 to the 265. What do we have? Which is greater? The book value we're giving up or the cash we receive? Obviously, the book value is greater, so we have a loss. We have a loss of $60,000. Okay, and that's going to be loss on sale of equipment. Loss on sale of machine for $60,000. Okay, and again, as all journal entries, the left side must equal the right side. That's a good way to test yourself to see if you figure things out correctly. We have $720,000 on the debit side and $720,000 on the credit side. Left must always equal right. Okay, it's a good way again to check yourself. What if instead of getting $205,000, we got $300,000 instead? $300,000 compared to $265 what we got, the proceeds from the sale is greater than the book value. So we have a gain of 35,000. So again, with the same entry, we're gonna take the accumulated depreciation off the books, what it was for those 6.5 years. All right, and we take the machinery off the books, $720,000. We apply the cash. How much cash do we get? In this case, scenario B or E, we get $300,000 of cash. So now we have a gain of 35,000. Gains are always on a credit side because gains always increase equity. Losses decrease equity, they're always debited. Gains always increase equity, they're always credited. So we have a gain on sale of equipment. Where is it? Right here. Boom. Okay. Again, the left side, 755,000 equals the right side, 755,000. Always a good way to check your answer. Left must always equal right. Debits must always equal credits. And that is how you account for fixed assets, property, plant, and equipment, capital assets, whatever you want to call them. Okay, I hope you enjoyed this video and stay tuned for more. You don't want to miss it. Accounting's fun.